And we come to the part of the show that we always have. It's definitely a favorite for many investors. And these are ideas or three things that I think individual investors should focus on before they make their investment decisions in the next few weeks. We're not talking the next 6 months from now. We want to talk about what's important today to understand and to focus on before you decide whether to buy this investment or that one, whether to buy that bond or that stock or that mutual fund, and which ones you want to buy. So the three ideas we have today. First, economic data. We have a very big jobs report looming this Friday, both in Canada and the US. US will definitely matter, I would say, a lot more this time than the Canadian jobs number. And that's because we just received our interest rate announcement by the Bank of Canada, but we have not yet received an interest rate announcement for this month by the Fed. So jobs data will be crucial as to what the Federal Reserve does, whether they lower rates. It's pretty much priced in they will lower rates, but whether they lower 25 or 50 basis points. Second point, understanding where we are in the calendar. I think this is really important. This was really important last year when we came into September. We saw a pretty large market decline at that time. And I think it's important for investors to understand where we are in the calendar and at what point or what we're entering September on a positive note. Is it a flat note? In this case, we're entering the month of September on a high note. Markets entered September pretty much at all-time high. So understanding where we are on the calendar, very, very important. And sustainability of stock movements. We've seen a lot of stocks move significantly higher. A lot of investment ideas move significantly higher. I think it's crucial to understand why these stocks have moved higher and to understand, are their movements sustainable? Can they continue to move higher, or should we expect a bit of a pullback in that stock idea? So let's move to the first topic, which is economic data. And as I mentioned, the number one economic point that I think investors need to focus on are jobs. I think the Federal Reserve and Bank of Canada, as I said earlier, are looking at jobs growth and jobs in general to understand what's going on in the economy. And jobs will affect interest rate policy, will affect the Fed policy, what they decide to do, because as we've said many times on the show, Federal Reserve and Bank of Canada have that dual mandate, price stability, which is what they've been focusing on for the last little while, which is inflation, but also full employment. They want to see full employment. They don't want to see unemployment run rampant and start to see a lot of job loss. Both Bank of Canada and the Federal Reserve definitely are keeping an eye on that. And I think the Federal Reserve is using the recent uptick in unemployment as a reason perhaps to start to lower rates. So jobs report this Friday is crucial for that. We have our first chart here on monthly jobs, US monthly jobs. We've shown this, I think, last show. And you can see a nice decline, unfortunately, in the last three readings from about over 200,000 to just under 200,000 to the most recent reading for the month of July, which was only 114,000 jobs created. And that caused a pretty big stir for the markets. Many started to become a little more fearful that the Fed perhaps was being was too late in the interest rate cutting cycle. They were too late to start or to begin to cut rates. Obviously, we know here in Canada, we've cut now 3 times. They've already cut in in Europe as well and other places around the world, but yet the Federal Reserve in the United States has yet to cut. So are they too far behind? Well, hopefully not. Market has been really resilient. So I think that's afforded the Fed some extra time before they started to cut their interest rates. Next chart we have here, again, U.S. unemployment. And this is what I was referring to. You can start to see U.S. unemployment is starting to move higher. This is starting to become a concern for the Fed. We've gone from the U.S. has gone from about a 3.5% unemployment rate to now something well over 4%, around 4.3%. If we see on Friday that we get a job, or the United States reports jobs of less than 100,000, I think there will be fear in the markets once again. The expectation is for jobs growth in and around 160,000 jobs created. Anything around there, I think, would be great. Anything too high, then maybe people will call into question whether the Fed will actually cut rates at all. Anything too low, and perhaps people will start calling for maybe a 50 basis point cut for the Fed come September the 18th. So again, Goldilocks, right? Not too hot, not too cold. Even the slightest deviation from what is being or what is expected could move markets. Next chart we have here, PCE, just showing you once again the preferred measure of inflation by the Federal Reserve coming in around 2.5%. And you can see a gradual decline there. Again, core PCE and headline PCE almost the same. I would say not much different and can be, I guess, taken as a 2.5% rate, well below the Fed funds rate of over 5%. And again, this is why we continue to say that there's a lot of room there, big gap between Fed funds rate and inflation rate, and that gap definitely needs to be closed. So we talked about how GDP is doing well in the United States. We talked about that in the past. Now we're talking about some slowdown in jobs growth. But another good point or another positive data point, I should say, out of the U.S. recently has been retail sales. We have a chart here showing retail sales, and you can see how well retail sales did this past reading. Came in around 3% above, 1% above what the expectation was. I think it was more of closer to a flat reading month over month. And it was a great reading, something that was not expected. Retail sales coming in a lot stronger. So that kind of took people by surprise a little bit. We thought things were slowing down, but yet the consumer continues to consume, continues to spend money. And that's unfortunately why we're seeing a lot of debt on individuals' credit cards. And our next chart here, as I kind of alluded to already, GDP growth. That is where we saw the 3% reading on GDP. GDP growth coming in at 3% in the United States. Again, above the initial reading for the latest quarter. Initial reading was 2.8%. Now it's popped up to 3%. So overall, here you have this soft landing that everybody was hoping for. You have some strength in the economy. You also have some weakness in the economy in the United States. And so you put the two together. And yeah, I guess it's afforded the Federal Reserve a little bit more time than the Bank of Canada before we see their first interest rate decline. So economic data, very important to focus on by individual investors over the next couple of weeks and getting some of those readings. We're also going to get a CPI reading as well and another retail sales reading before the 18th of September, where the Fed makes their decision on whether to cut rates and by how much. Second point I wanted to discuss is understanding where we are in the calendar for the year. And as we've talked about many times, September is notorious for being the weakest month for returns for individual investors. Now, before I go any further, I'm not saying that individual investors should come into September, sell their investments to buy them back at, say, the start of October. That's just not the way it works. It's never an exact science. It's never perfect. It's very hard to time these markets. However, we know historically from the data that September tends to be a weak month. And here we are, once again, entering the month of September on a high. We entered the month of September last year on a high, and we saw the markets decline. And we're also entering the month of September with valuations pretty well stretched at this point. We're seeing PE ratios at the higher end of the range that they've been in for a little while. So coming into a notoriously weaker month at a high point for the indices, with markets perhaps slightly stretched on a PE multiple basis, perhaps we could see some volatility. And obviously, as we've talked about already, we're going to see some interest rate movements. We saw already by the Bank of Canada, we should see at least a quarter point cut by the Fed. How are the markets going to react? So first chart I wanted to put up here is a chart on the S&P 500. It's a one-year chart. And you can clearly see, there it is, that we are coming in, even though we saw a bit of a dip. First trading day yesterday for the broader markets. Obviously, Monday, Labor Day, and no markets were open. But coming into September, you can see S&P 500 are at a high point. Let's pull up the TSX. Where were they coming into September? And you'll see that we also, on the TSX, coming in at an all-time high, or pretty close to an all-time high. I could also tell you we don't have a chart for it, but the Dow Jones just reached new all-time highs at the end of August as well. So here we are coming into the month of September, a notoriously weaker month, and we're sitting at all-time highs. Let's take a look at valuations. S&P 500 PE ratio. We have a chart on that as well. And you can see how as we move this chart to the right side here, you could clearly see that valuations or PEs are starting to rise for the broader S&P 500. Is that a good thing? Well, obviously not. We love to see PEs stay in that good value or fair value range. We're starting to see fair value, and in some places in the market, slightly higher value for the S&P 500, certain sectors of the S&P 500. So again, do we want to just blindly sell things because the markets are coming in at all-time highs and we know the month of September is more of a difficult month? Absolutely not. We don't know how things are going to play out. We're going to get an interest rate cut more than likely by the Fed on September the 18th. Will the markets respond positively? Will they respond perhaps negatively? Will they sell the news, buy the rumor, and then sell the news on the 18th? Many people believe, including myself, that we could see a bit of a sell-off in and around the date of September the 18th when the Fed cuts, because I think the investors in the market will expect it. It's already priced in. So it just depends on what the Fed says. Is this one cut on the way to 2 or 3 cuts by the end of the year? Or are they going to say this is one cut for now and we will see? So a lot to be determined, and a lot will depend on what the Federal Reserve does. But again, keep in mind as an investor, when you're investing this month, where we are in the calendar. The third point I wanted to focus on for individual investors is this idea of sustainability of stock prices or stock movements. And I thought this was important because I still get quite a number of individuals, a number of investors asking me, Alan, should I be buying NVIDIA? Should I be buying Eli Lilly? Both stocks have had tremendous runs. NVIDIA obviously has had a bit of a pullback recently. We've seen a couple of pullbacks this year. Eli Lilly had a pretty big pullback not too long ago and now has surged once again. And what I think is extremely important is not just seeing these stocks move higher and wondering whether you should buy them or not, but you really need to understand why they moved higher. If they can sustain their share prices, can their share prices continue to move higher based on what the company is doing, based on valuation, etc. That's probably even more important than just guessing or getting into a name just because it's done well in the past. So in the case of NVIDIA, we have a chart here on NVIDIA. Case of NVIDIA, obviously, #1 chip designer, creator, maker for artificial intelligence. They also are very big into the gaming space. NVIDIA was known for gaming up until the AI boom of the last few years. So NVIDIA has reported fantastic quarters, one after the next after the next. A couple of quarters ago, grew by over 200%. This past quarter, they grew by about 130%, grew their profits, that is, by 130%. So a couple quarters ago, 200% growth, fantastic. This past quarter, over 130% growth, maybe not as good as 200% growth, but still doubled in terms of what they've made in this past quarter on an annual basis if you compare it to what they made a year ago. Yet, what were the headlines? Well, the headlines weren't, well, NVIDIA doubled its profits or how much they made. The headline was, is their growth slowing down? And that really, in my opinion, was the reason for a sell-off, a recent sell-off in the price of NVIDIA. A lot of people talking about, did we see the high points for their growth rates, or the high points for their growth rates in the past, in the rearview mirror? And we're now going to consistently see slower growth. Obviously, as businesses become larger, as we've said many times on the show, they do become a victim of their own successes, and it becomes more and more difficult, especially being a $3 trillion company, as NVIDIA is, to continue to grow their profits, their revenues, 200%, even over 100%. And so, yes, it is expected that the profitability will start to slow down, but that doesn't mean the company is not a good company. But does that mean that the share price will be in tough? Does that mean the share price will be able to go up as quickly as it has in the past? Well, the answer is possibly not. And so that's why I think it's important to understand NVIDIA, understand any stock, to figure out, is it possible to see the share prices continue to rise, especially at the rate that they've had in the past. A lot of, I guess, individual calls on NVIDIA by analysts. A lot of people have the stock moving up to 150. Some people have the stock moving up to 100, 135. Today it trades just under 110. Before we came on air, it was actually up today. Had a big down day yesterday, up today. So understanding the movement, understanding why NVIDIA has done what it's done is very important to understand if it can continue and whether you should be buying NVIDIA at this time. Another stock that we have here, Eli Lilly. Nice chart of Eli Lilly. You can see a pretty drastic down slope there, then followed by another uptrend. Stock is trading near all-time highs once again. But again, Eli Lilly, different business, pharmaceutical. Their big, I guess their main reason for the growth and the share appreciation is their weight loss drugs. Once upon a time, Eli Lilly had diabetes drugs. Now those individuals who were taking the drugs were starting to take it for weight loss. Now they have weight loss drugs, and that has been at the forefront really of their growth. So once again, can their growth continue? Is their stock price appreciation sustainable? Can they take it to the next level? Can we see a $1 trillion market cap on Eli Lilly? Can we see a stock price above $1,000? Well, that will depend, in my opinion. I think it's going to depend on competition. We're hearing more and more drug companies, we're hearing more and more pharmaceutical companies coming out with weight loss drugs, whether it's Pfizer, whether it's Amgen. People are talking about a pill versus injections to lose weight. So I think it's going to depend on competition. It's going to depend on Eli Lilly's pipeline. Do they have other drugs to complement the weight loss drugs? I think they do, in Alzheimer's and other areas. So it is possible perhaps to see Eli Lilly above $1,000. But again, that is what individual investors need to assess before they invest in a name like Eli Lilly. Can it continue to go higher? Is it stock moving higher for good reasons? And is it sustainable? The third stock I have here, totally different than the first two, a name that I think everyone has probably heard of, and that is GameStop. Probably the #1 meme stock, as they call it, that we've had in the last few years. And you can see here on the chart, two pretty large spikes higher and then pretty sharp declines downward. So here you have a stock, again, that gone up. A lot of people were wondering at the time, should I get involved in a name like GameStop? Is the run-up in the stock price sustainable? Well, you can clearly see that it has not been, because this stock, I can honestly say, was pretty much moving higher on hype. There really wasn't much fundamentally behind the name. Not that GameStop did not report decent earnings or profits. They did. However, definitely the price movement from the stock, from the company, in my opinion, just wasn't justified. And how do we know that that actually was the case? Well, you can see how quickly the stock sold off just as fast as it went higher. So overall, as an investor, I think you want to look at look at sustainability of share prices. You want to look to see if the share appreciation, the share price appreciation is sustainable over a period of time. And more importantly, is it sustainable for the future? You look at that, you take a look at the economic data that's going to be coming out over the next few days with jobs. You want to look at, understanding where we are in the calendar for this year. And those are the three ideas that I think individual investors should be focused on before you make your next investment decisions.